Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We saw third quarter GDP growth come out yesterday, 2.6%. Sounds great. That's third quarter. We're already in the fourth quarter. Kansas City Fed Manufacturing Index collapsing into contraction. It's joining heaps of other Fed indexes, all pointing the same way on manufacturing and factory activity, and it's all south. Now, in the GDP data, sounds good, 2.6%. People are expecting 2.4, a little bit better, but it's a disastrous number, and here's why. The reason that number looks good is because of massive LNG exports to Europe to try and offset the loss from Russian supply. But the best they can do is replace 20% of Russian supply, but it helps. But what it does is it's a massive export boom, makes the GDP number look good. At the same time, that imports, in other words, the health of the US economy, were very weak indeed. Also, we saw goods, food, beverages all trailing badly. So some things looked good, like services, but it's mostly because the cost of services have gone up, and some of these services people just simply have to get, like health, for instance. So it's not a great GDP number for the underlying reasons as to why it was a positive number. It follows 2 quarters of negative growth, which means for the whole 9 months of 2022, the US economy has only grown 0.4% for 9 months. And in Q4, this could easily be another negative number. Now, the supplies of LNG to Europe will continue, but manufacturing services, remember we just saw services go into contraction according to the S&P 500 global PMI index for the United States. Overall private activity went into contraction, and services went into contraction, and manufacturing hit a 14-month low. So it's not a good situation, even with that third quarter number, and fourth quarter is unlikely to be as good. So I'm still saying ongoing rolling recessionary negative type quarter periods, positive, negative, but it's sort of always tempting and tinkering on the edge of depression in the United States now. The problem with all of that is that the Federal Reserve will not see it this way. Just as when we said inflation wasn't transitory, they didn't see it that way. Just as I've been saying they'd be raising interest rates too aggressively, too late, they didn't see it that way, we did. That's what's happening. The problem with the GDP number, as I've just explained it, is that we're actually going to see the Feds encouraged to continue to hike aggressively. I thought we might have one more 75-point rate hike from the Fed, and then we would have some sort of 50-point period. But now I think it's 75 points for the next 2-3 meetings, perhaps, at least the next 2 meetings now. So the Fed will take that as a green light to keep hiking interest rates and proffering this nonsense argument and narrative that the US economy is strong. Of course it isn't. Now, new jobless claims, the weekly number, they seem to have stabilized around 220,000, which is actually a healthy number, but it still means a lot of people are losing their jobs every week. And it is sort of, it's in keeping with there is shortage of supply, which I keep trying to explain to people means the US economy has a dysfunction at the moment, a problem. There is a disconnect, and we all know the background to that. But don't read US employment and jobs numbers as positive. They're reflecting a dysfunction. Meanwhile, economic data of all other shapes, sizes, and forms, even that GDP number, when you look at why it was that number, are telling a very ugly story. So be careful of the US. For the moment, the US dollar will continue to be bought because the Fed will be continuing to hike interest rates. That's all well and good. At some point, the US dollar will collapse, but it might do so from 20-30% higher than what it is now. Maybe what we saw in the yen is what the US dollar is going to do to the euro, to the Australian dollar. It's not over yet. Remember, my forecasts for the Australian dollar have been remarkably accurate for the last 18 months. Touch wood. Where's the wood? Touch wood. So I must get it wrong at some point. That's why a lot of people make the mistake with fund managers. When they've had really strong performance, they want to invest in that fund. No, that's when you shouldn't invest in it. They've just had a good run. They're likely to go into a period of consolidation or correction. When a good long-term performing overall fund has a corrective period but starts to make profits, that's when you go into a fund. So it's just like trading markets. So my views, I've been getting it right. How much longer can I get it right on this Australian dollar? I don't know, but at the end of last year, I said 65 cents this year, tick with risk to 58 cents, probably in 2023, but I brought that forward to this year a few months ago. So that's still the risk, 58 cents. So we're not sure what this US dollar is going to do. But at some point, as I said, I think yesterday or previous video, the US dollar has to be, it's disconnecting from the US economy. So at some point, where does only interest rates matter and nothing else about the United States economy or situation? So that's when the bubble will burst, when that extension has gone far enough. We're not there yet. So still US dollar bullish. Very bullish. Oil, I've been saying buy oil for a while. I got oil wrong for a while, but we're getting oil right again. Oil looks like one of the best hedges against an ongoing deterioration of the geopolitical global situation. That could involve a global economic slowdown, but a global economic depression, and much worse, has already been priced into the oil price. So I don't see that dragging it a lot lower still. So I do think oil is still a buy because it's been oversold on fundamental reasons, and I'm an economic bear, but oil went too low, so it's got to come back. It's like pushing a beach ball under the water. I was thinking of Wall Street, push Wall Street under the water. Push a beach ball under the water, and what happens when you take your hands off? It pops. That's what oil's doing now. So watch for that. What else to watch for? Oh, Meta dropped 25%. Yes, our old friends at Facebook, 25% off. And they've been trending down all year. It's just been a massive sell market. Apple, watch Apple. It's just starting to turn over. Tesla, watch Tesla, a very vulnerable stock. Love the company, don't like the price. Said it before. All right, I hope you have a very good weekend. There's lots happening and it's all full of opportunity. Have a great day. Thank you.